You and I were invested in similar investments with the mutual funds that are provided through Nelson Financial Planning.
Right.
But then at the end of the conversation, it's like, what's important to you? It's like, well, I got a lot of years for the money to grow.
Right.
And I'm like, I need this money to be stable and start thinking about generating income and taking some withdrawals. It's, for my end, it's really, the long-term, I would use the word marathon.
Right.
And I'm going to go into a little more detail about why I like to use that word marathon. You might find it a little more on the challenging side of, what the big picture looks like, but you're really just trying to get growth right now.
Yeah, no, absolutely. I mean, like you said, we talk every afternoon about kind of what's happened throughout the day in the market and that sort of thing. But yeah, I mean, I guess the biggest word or the biggest difference would be, I guess, risk tolerance at this point. What a young investor can handle volatility-wise, swing-wise is a lot different than somebody nearing retirement. What they would be comfortable with is frankly, much different than what I would be comfortable with in terms of market swings.
Of course. And so, I like to use the analogy, especially today, of, the long-term investing is kind of like a marathon. And I throw that out because our boss and the president of Nelson Financial Planning is actually running a marathon in St. Pete, Florida, as we speak, as this show is being broadcast. And so that's what allowed you and I the opportunity to step in, fill in his shoes the best we could, and talk about investing in our ways. And since we sort of have an older investor such as myself and a slightly younger investor such as you, we thought, well, why don't we just talk about the similarities and then some of the differences that investors would have as they're making their decisions for the short term, mid-term, and long term. Because my definition of short term is probably, still very short, because I need to get more to the midterm, long term, where at retirement I need my money to work in a certain way, and my goals for pure growth have already, hopefully I've established that early enough that that's not my number one goal is to try to get the maximum growth over the next couple of years.
Right. Yeah. I mean, it's as simple as, for someone like myself or anybody in my relative age bracket, just as a hypothetical example, the market drops 30% in 1 year. That's nothing more than a buying opportunity for someone like myself. Really not